Welcome to the Notary News Channel. My name is Desiree Roman Rodriguez, and I'm a subject matter expert in all things notary in the state of Illinois. I am also an enrolled agent. An enrolled agent is a tax specialist that is credentialed by the Internal Revenue Service. An enrolled agent can represent a taxpayer whether they prepared their tax return or not, and they can represent that taxpayer to help resolve any tax issues all the way up through the U.S. courts. This week's session, we're going to be focusing on tax information, and because the tax topic is so large, we're actually going to have two sessions, one this week and then again one next week. This week we're going to be focusing our session on self-employment tax, meaning Social Security and Medicare tax, filling out a Schedule C and how that's going to impact your 1040 to determine whether or not you will owe taxes. Now, as a business that does independent contractor work, you receive a 1099, you're not receiving a W-2, it means that essentially you're going to have a very different tax return than you normally would if you were working for someone else and you had a W-2 job and your tax return was a lot more simple, as opposed to having a 1099 and needing to do other things with your tax return, essentially meaning you will have other forms to file that you normally would not file if you had a regular W-2. Now, as a professional, you must look at your taxes and your overall financial situation as crucial to running a successful business. So if you aren't on top of what your expenses are, you don't know how to minimize the cost of doing business, and you find yourself spending way more than you're earning, then you're never going to show a profit. And the IRS does have a rule that if after 3 years your business is not showing a profit, they can reclassify your business as a hobby and then go back and disqualify all of the deductions you've made on previous year's tax returns so that you would not get those deductions. So it's very important at some point to be able for your business to start showing a profit. Now, you have to think about your financial health the same way that you would about your physical health. So if you have a headache or you have a small cut on your finger, then you can take some aspirin, you can wrap a Band-Aid on your finger, you can take care of that yourself. But when things start to be a little bit more intense, you have serious pain and you can't walk, or you break a bone, now it's time to see the doctor. Well, in that same way is how you have to think of your tax situation. If it's a simple return, a single W-2, that's something that you can handle yourself. But once your return starts to get complex, then you want to look for more professional help. And an enrolled agent or a CPA will always be your best bet. So the first thing we're going to start to review is going to be, do you owe taxes? Will you owe taxes? How do you know you're going to owe taxes? What kinds of expenses are deductible? What's the best strategy for your situation? Well, those are the kinds of things that you would normally need to discuss with your enrolled agent or your CPA. But in the beginning, you can kind of figure some of those things out for yourself. So the self-employment tax is going to be something that you're going to need to pay no matter what, unless, of course, your business doesn't show a profit. But very often, as an enrolled agent, I have seen people bring in tax returns done by regular tax preparers who did not account for the deductions that they should get as someone who is considered an independent contractor and ended up paying a significant amount of taxes that they otherwise should not have. And in those cases, we will usually advise for them to amend their tax return so that they can go ahead and get the deductions that they were entitled to get. But your self-employment tax is going to be something that an independent contractor, you have to pay for yourself. When you work for an employer, your employer pays half of those taxes, which is basically your Social Security and Medicare tax. The tax is based on 15%. So your employer pays 7.5%, and then you pay 7.5% from out of your wages. Those are the taxes that you would pay and gets deducted directly from your W-2. Now, if you don't have the correct amount withheld from your paycheck, then at the end of the year you may find yourself owing. And in that way, you want to make sure that's not happening to you if you're an independent contractor, because as an independent contractor, you pay the entire 15%. So you want to make sure that you have your tax situation set up correctly so that you can either not pay self-employment tax or set aside the funds to pay those when it's due. Now, if you are profitable, if your business is profitable, and you will need to pay taxes on your income once your Schedule C has been figured out. Your Schedule C is where your expenses and your income is going to be recognized as an independent contractor. And you have to make sure also that you are eligible for the deductions that you are making. Now, in our second part of our tax information session, we will talk more about deductions and what is the kinds of deductions you would normally qualify to get and what would be the best strategy for you, and probably some recommendations. But again, those kind of conversations are essential for you to have with an enrolled agent or your CPA. But in the meanwhile, when you're filling out your Schedule C, your Schedule C is going to show all of the income that you've earned. That means any 1099s you were issued, any checks that you cashed, any quick pays or PayPal deposits that you received. All of that income gets counted. Then you would have to make the deductions of your expenses, and you have to be very careful of what you're deducting. With the tax law changes that were implemented in 2018, a lot of the deductions are no longer available. So for example, for a business, you are no longer able to deduct entertainment expenses. So you have to be knowledgeable about what you can deduct and what you cannot deduct. Oftentimes someone thinks because they rent an apartment that they're not able to deduct a home office expense, and that's just not the case. So even let's just say you had a very profitable year, even with after your deductions, you still had a lot of income left over. Well, again, one of the changes from 2018 was this wonderful little deduction called QBI, Qualified Business Income Deduction. And it was a deduction that was meant for large businesses and corporations, essentially giving them a 20% deduction on top of all the other deductions they received if they had leftover profit. Wonderfully, for small businesses, you are able to take advantage of that as well. So if after you've deducted your expenses and you still had profit left over, then you would be able to take your qualified business income deduction, an additional 20% deduction on that as well. One of the things that people get a little nervous about is taking deductions that they're qualified to take. They feel that they don't want to take too many deductions because they don't want the IRS to look at their tax return. But one of the biggest things that the IRS is going to look for is consistency in your tax return. If one thing's different from the year before, so if you put this year that you spent $5,000 on auto expenses, and then the next year you spent $10,000 on auto expenses, if your revenue doesn't significantly increase from one year to the next, that's going to give the IRS a reason to take a double look at your tax return. The other thing that will make them double look at your tax return is if you're saying that you earned $40,000 and then you wash away all of that income with $40,000 worth of expenses, then you're telling the IRS you had no income. And the first thing that the IRS is going to question is, well, how did you support yourself? How did you pay your rent? How did you eat? So that would definitely be something that's a red flag. A lot of times people think, oh, I want to make it zero. I want to show that I used all the money that I made and I spent it all in the business. Well, that would be okay if you had another means of paying your light for your own rent, because remember, your personal rent is not going to be a business deduction. So the IRS is still going to want to know, well, if you made 40,000, you have no other income, how did you live for the year? So those would be things that the IRS would look for. So going back to your Schedule C, once you made your deductions and show that you had some profit, you can use the QBI deduction to reduce it further down, and then that profit would then move toward your 1040 form, which would be counted as income against any other income you've earned. Now, what are other sources of income that's counted as income along with your independent contractor earnings? Well, that's going to be any other job. If you had a part-time job, if you kept your W-2 job while you did notary work, that would be added to that income. Any Social Security or supplemental income that you get from that would be counted. If you're doing any withdrawals from a 401k or a retirement plan, those would all count as income. A lot of times people think if they do a withdrawal from their 401k, they don't have to pay tax on that, and that is not the case. You always have to pay the tax on your 401k income, whether you're taking it before or after you're retired. The difference is if you're taking it once you have hit retirement age, you won't have to pay a penalty. But if you are taking it prior to retirement age, not only do you have to pay the tax, you will also have to pay a penalty. Now, other income is dividends or interest that you receive on checking accounts. If you're doing any kind of investments, you also have to pay tax on lottery winnings. So usually you would get issued a W-2G and you would have to pay tax on that lottery winnings as well. Now, if you want to discount the winnings and offset it by losses, you have to be able to prove you had just as much losses. So if you won $10,000 in the lottery, then you have to be able to prove you had at least $10,000 in losses. And if you can't prove that, you would not be able to offset it with losses. So your gross income then gets tabulated on your 1040, and then obviously we no longer have itemized deductions, or rather exemptions, personal exemptions. So that's no longer something that you are able to use to reduce your overall taxable income. So the only thing left then would be your standard or your itemized deduction. So the difference between standard deduction is you don't own a house, you don't have interest payments that you're paying on a home, you don't have deductions for paying property taxes and that kind of stuff. So in that case, you would just take the standard deduction. It would be $12,000 for a single person, $18,000 if you are caring for someone and are classified as head of household, or $24,000 if you are married. And so once that amount is deducted off of your total gross income, then you now have your adjustable gross income, and that is what becomes deductible. Now that is what becomes taxable. So now you can have other items offset again what you pay, or what is considered your full taxable income. So for example, if you're making student loan payments, the amount of the interest paid on those would further reduce your adjusted gross income. If you're making alimony payments, that you would be able to reduce it. If you're receiving alimony payments, that's going to get added back in. You're going to have to pay tax on that. And of course, that's for divorces before 2019. If you were divorced after that, that no longer applies to you. So if you have children, of course, there's the child tax credit. If you're taking care of an older parent, you'll have another dependent credit. If you're going to school, the American Opportunity Credit, those would be credits that would give you cash back if you're paying for child care expenses. All of those things would give you credits to offset what you would have to pay for your taxes. And then once that you get to that final number, you may not qualify for any of those credits, but once you get to that final number, that will determine then what the tax is on that total income, and then you would either find yourself owing or you would find yourself getting a refund. Now, a lot of people don't understand that you can pay an underpayment penalty. If you end up owing the IRS over $1,000 at the end of the year, there is an underpayment penalty for that, and you will need to pay that. In the state of Illinois, they also have an underpayment penalty. Their limit is a lot lower. If you owe the state of Illinois more than $500, you would have to pay an underpayment penalty. And another thing that people don't realize is they feel that if they file an extension, then that gives them more time to pay if they owe taxes. And that is not the case. If you file an extension, you are filing to waive the penalty for filing late. There is no waiver for paying late. So if you are not going to be able to get your taxes completed on time, then you want to make sure to go ahead and file the extension and make a guess, an estimated guess of if you think that you will owe tax, and that has to be paid by the tax deadline. Now also if you are having a regular business, then your business tax return will need to be filed before you can file your personal tax return, because you're going to need documents issued by your business to file with your personal tax return. So that's going to be it for this week in a nutshell. Stay tuned for next week. We go a little bit more in depth regarding the deductions and estimated tax payments. And if you have any questions that you would like us to answer for you, you can either post them down in the comments. You can also send your questions to our Twitter channel at Notary News, and we'll respond to you that way. Or you can send us an email, info@romanendeavors.com. So thank you so much for joining us today, and please subscribe below. Thank you.